Right on, guys. Welcome back to the Independent Investor Channel. My name is Ryan. I've already run you guys through the exercise of identifying what type of investor you want to be. In other words, what style of investing do you want to deploy when you're thinking about getting involved in the stock market? What preliminary questions to ask yourself? And it can be really, really difficult. It really can. With no experience, you're being asked to make some decisions that will, in fact, impact your future. They will. You're not going to be immune to mistakes when you start. You're really not. But I thought I would come out with this video and offer my specific investing profile. And hopefully by declaring my investor style to you guys, you can kind of understand this has taken me, a couple decades to fine tune. Lots of mistakes, lots of falling on my face, no doubt about it. This is the cool thing about YouTube, is that we can comb over some of those mistakes and I can provide those to you guys, because I always sit back and I ask the very same question every single time I put out content online. How is this going to be received by my community? How is it they can deploy the little tidbits that I offer in their own financial future, right? What of these strategies can you deploy on a day-to-day basis in the trenches, right? Advice that you can take and utilize tomorrow, right? I'm very, very passionate about investing. And as I look back over my evolved investing style, it's become very, very clear to me. And this is why when I see folks going down the road of a single investing style, I always cringe a little bit, okay? I really think that you need to open your eyes, and some of you guys who are Bruce Lee fans are gonna really, you're gonna gravitate to this, and I don't mean to date myself, but to not have any style is really the idea. To be dynamic in your application. Investing is no different. At a certain juncture, you're going to need to put some capital to risk, okay? There's no real other way. Now, I can go into in-depth historical precedents in the stock market, ebbs and flows that have worked historically over time. If you're a student of the stock market, that stuff is really interesting. But I think the idea is that when you deploy your plan, you give yourself the best chance of succeeding with that plan and take on that plan with as little risk as you can possibly stomach. Okay? So you want to have both. So what I'm going to do for you guys is I'm going to define some of the factors that go into my investing style. All right, these are some of the contributing factors. These are some of the things that I've got going on in my life. Some of you may have similar things going on. You may have additional things going on. You may not have some of these things, okay? But the idea is that you go through this progression of thought when you're looking to define your own investor style. Some of the factors that impact the way I deploy capital and the way I justify the risk that I take is very, very simple, okay? The first one is that I should be, if I hold true, in 6 years, eligible for a military pension, okay? This is a benefit to the military that I should earn if all things pan out correctly. At least over the next 6 years, I will become pension eligible, okay? And I will be guaranteed a pension based on my rank when I get out, okay? When I retire from my regular job. How does this have to do with my plan now? If I didn't have that pension down the line, do you think I would be more aggressive or less aggressive, okay? I'll leave that rhetorical answer up to you. I know what mine is. No way, I don't play that way, okay? If I didn't have that money in my future waiting for me, I would absolutely take a plan now that wasn't quite as aggressive, that was a little bit more passive, okay? Now that doesn't mean that you can't take on risk, but knowing that I have that down the line is a big, big positive for me, okay? The next factor is The thrift savings plan for me, this is going to be similar to a lot of your guys' 401ks. If you've got those buffers and you're happy with them and you shut the channel off and you're good and you don't want to talk about investing anymore, you're good with your program, you're happy, it's going to be what it is when I retire, okay? Look at it from my perspective. My perspective is such that you're going to have that money. You're contributing to it, whether it's matched or it's not, but you're contributing X number of dollars out of your paycheck to that pension. Wouldn't you think that that would provide a little bit more fitness for you to maybe take on a little bit more risk? Okay, maybe justify an additional individual account for yourself? It does for me. It does for me. Not only that, but my TSP that I have specifically, I'm limited in my options in the TSP. Therefore, it's justification for me, because of my limited options, as good as they are, to start that additional account for myself, right? And maybe put some assets in that account with the idea of eliminating overlap between the two accounts, that the two accounts supplement each other, they complement each other, right? The third factor is tax protection. Very, very important. I envision myself reaching 59.5 someday. I would love the prospects of looking back over my investment career, pitfalls, successes, whatever it is in a nutshell, look back and say, I can take $250,000 out of this account and the government can't touch one dime. I just like the prospects of that. Now, that might not be something that is attractive to somebody out there, but it is absolutely attractive to me. And I'll tell you how we meet that goal when we start to actually define our investor style. But part of your routine should be to keep the government away from your money. That should absolutely play into the equation, all right? Number 4 is wealth preservation. This is a term that I don't hear very often. I believe I started using it because it just made sense to me. When we're talking about entering into accounts, okay, buckets, for a lack of a better term, that's all an account is, okay? It's just the conduit that provides you the access to the market. The rest is aesthetics. It really is. The rest is aesthetics. So people ask me all the time, should I go with Vanguard or go with Merrill? Well, do you want incentive thresholds on the Merrill side, or do you want to wait till $500,000 to go with Vanguard? Okay, that's a big aesthetic difference. The similarity between the two is they're both buckets. They're both accounts, all right? So that's where you need to do your research, is understanding what gives you the most bang for your buck or the most bang free of charge, okay? That's wealth preservation. Not being nickeled and dimed within your accounts to be subject to dollar cost average fees, entry and exit fees, annual fees, dividend reinvestment fees, all those fees that are traditionally charged in a managed account. The wealth preservation piece is one of the factors that play into how aggressive or how moderate I'm going to be with my application. It all comes first full circle, guys. Number 5, a factor for me that is extremely important is diversification in one word. This is not talked about enough on YouTube. It seemingly is just an out of favor term. It's not sexy with the new generation, okay? And I would love some of the new generation to come on and challenge me and say, you know what, Ryan, we get it. We found the old school historical references that talk about the importance of not trying to cherry pick our portfolios. Just buy the whole damn market. Buy the whole thing, okay? That way you're guaranteeing the whole enchilada, that you're getting the bads with the goods, the growth with the value, and there it is. You got it, okay? Diversification. It's one of those things that gets kicked to the curb all the time, especially on YouTube. And some of the portfolios that I look at, it's insane. Stock-only portfolios, right? You're not diversified. I don't care if you have 50 stocks. I don't care if you have 100 stocks. You are not diversified in the manner that I would insist to be diversified for me. These are my factors, all right? Number 6. I do insist on some dividend income. This is a personal philosophy for me, okay? Now, Does that mean that I go out and I seek out dividend income exclusively? No, I do not. I do not believe in limiting one's style to one specific style. You can talk yourself into it all you want. At the end of the day, you're probably leaving a lot of capital on the table by seeking out one avenue and one avenue only, okay? But dividend income is important to me, and I declare to you guys how I seek out that specific dividend income to meet this particular factor for me, okay? Now, let's get on to investing style. Here's my investing style in a nutshell. In the definition of your own investor profile, I had you look at the prospects of being either a passive or an active investor. I contend I am absolutely 100% both. I'm both. I'm both. I do not find any value in limiting my style as moderately aggressive as I am, and I am right smack in between. It bothers me sometimes when I'm looking at allocation models. I'm right in between moderate aggressive and aggressive. I kid you not, I'm right in the middle, of course, all right? Because I don't quite fit that allocation for aggressive, and I'm not quite as conservative in the moderately aggressive camp. I like it to be at that sweet spot right in between the two. Moderately aggressive is kind of where I am with my profile, but to meet that, I'm absolutely passive and active in my program, okay? How can I do that? Why don't I just camp all my money into an index fund? I know how important that is. I know that investors can succeed over the long term with index funds investing. That may be true, but the prospects of active investing in respect to the factors that I just gave you absolutely come full circle in meeting all of the factors that I just laid out to you, all right? Now, to meet the tax protection piece and the wealth preservation piece, it's the most common thread that I mention on YouTube, and I've reviewed a few little bit of content online this week. Really perked my curiosity. Very interesting, okay? The down on ETFs, down on index. The index fund market is in a bubble. No, it's not. It's not, okay? If BlackRock is not in a bubble, then neither is Vanguard with their measly $5.5 trillion in assets that have come into the firm since the ETF index fund started really gaining traction, and they really started taking in a lot of inflows. And I'm not going to argue that, but it is absolutely interesting to me how people with agendas, okay, will do everything they can do to skew the argument to say somehow we're in a bubble and it's going to burst, but nobody knows when. That is not good enough for me, okay? It's not. Because the reality is nobody knows. I hate to break it to you, okay? If I came on and I said I know, and based on this and this and this, and this is what happened because it's a similar situation in the past, you guys would be best advised just to walk away from the Independent Investor channel. You guys know that's not my program. Sometimes it's best to just say, I don't know. I don't know, all right? But over the last 30 years, 35 years of index fund ETF investing, it really has provided that passive approach for people. Now, the secret on the Independent Investor channel is while those folks are trying to discredit index fund, ETF investing, as well as dividend investing, it gets thrown on the chopping block all the time, and that's fine. Seemingly, you've got me in the corner with my 16,000 subscribers that could, trying to throw a white flag for everybody and say, hold on a second, if I jam some of these funds into the account that's a self-directed Roth IRA account, I don't get very much attention because a lot of people don't know it exists, all right? That's where I come in, all right? This is where you can call most of your major brokerage houses and ask them, what is the self-directed IRA? What do I get out of it? Do I have to pay dollar cost average fees, management fees, annual fees, etc., the fees? Am I subject to your disclosure form that you give everybody but that nobody reads, okay? I'm summarizing for you. You don't need it, okay? If you're going to go passive or even active, do it in a self-directed Roth. It's going to give you two things. It's going to give you the tax protection, so when you're 59, reflecting on your life, you're going to be like, I remember when I turned on that unrefined YouTube guy. But he was throwing out terms that I ground truthed for myself, and lo and behold, it was true. Amazing stuff, okay? So you'll get that wealth protection, and some of the discount brokers, that's why we offer those. The first trade in the M1 Finance, because I was tired of having people come to me and say, Ryan, how can I seek out my exposure to the stock market without getting piecemealed by the $5 to $7 entry exit fees? It adds up. It really does. If I'm going to invest in dollar cost average every 2 weeks or every month, it freaking adds up. $7 is a lot of money to a lot of people, man. When you're starting out, that means a lot. And if you can take those dollars and leverage them and put every single dollar for dollar to work for you, that's very, very attractive, okay? I'm not trying to sell you on anything, okay? Sell yourself on this material. You'll be glad that you did, all right? Number 4 is to maximize my incentives, okay? I'm at a threshold with Merrill to where I get those entry and exit fees. So not only do I get my cake, but I get to eat it too. What I mean by that is I get my free trades and I get the advanced data and analytics, which I'm so happy to have. It allows me to go on and look at what a moderate aggressive portfolio would look like and adjust accordingly. Very simple. Some of the discount brokers have those features, all right? You just got to seek them out. But to maximize incentives, I maximize incentives. I'll go in more depth on this in later videos when I'm talking about the budget and the credit card side of the house, the inflow and outflow, how I deal with those. Very, very unique, okay? But I'm looking to leverage my incentives in my investing accounts, and that's to get as much as I can for free. And if Merrill doesn't like it, I'll take my business down the road to the next bank, okay? I owe no loyalty to the bank. They better provide me the service because I have a lot of capital with them, that of which they're making money on while it's sitting as a number in their computer system, okay? They better be loyal to me, and I'll be loyal to them. And I have for 20 years. They've been phenomenal. Number 5 is where we start to actually put products in place that actually define our investing style, right? This is where the rubber meets the road. This is where I really get interested in folks that talk about an index fund bubble, dividend investing being no good, or it's the only way. Why not just do it all? I've said this for years on YouTube, and nobody really got me. Nobody. I do specialty ETFs, I do index funds, I do ETFs, I do bond ETFs, I do cash, which cash isn't an investment, but I do it. And if I could add precious metals and alternative investments to that, we'll talk about that another day. If you guys want to hit me up on the live stream and ask me what I meant by that, you can certainly do that. But alternative investments, why not? Why not do it all? Do not define your investor style by using one specific style. There is evidence against doing that. And I highly encourage you, if you're not doing it all, I would look yourself in the mirror, okay? The way I meet my investor profile is to have multiple stocks within my portfolio, multiple ETFs in my portfolio, multiple index funds within my thrift savings plan, and it all comes together in a nice, beautiful portfolio. Perfect? No, it's not. If I was going to be critical over my own portfolio right now, I would say that I'm slightly over-levered to single stock allocation, and I'm trying to slowly transition that into the index fund, but I'm running up against a wall with this current stock market. It's very, very difficult to justify putting large chunks of capital into indexing right now, okay? And I'll wait, that's fine. If I'm wrong, but I will wait because I have to be patient. It does not feel right to just maneuver a good chunk over to indexing right now. I will wait, okay? I will take profits in every single one of those single stocks that I have, reduce some of those positions and filter some of those dollars into index funds and ETFs. I'm already dollar cost averaging the index funds that I have. I'm looking to establish a little bit larger positions in the ETFs, all right? And finally, just to mention my dividend income, I do that through the single stock allocation. This is the small piece of the active profile. What I don't want to see happen is people come onto the Independent Investor channel and they hear what they want to hear. Ryan owns single stock, therefore I can buy single stock. No. I've just spent 20 minutes talking about the factors that go into why I justify buying the best quality single stocks. You guys know what portfolio I'm rolling with. I don't go with second tier companies. I don't. I go with molasses growing, dividend payers, best of breed, and I've made a lot of money doing that. Value investing, and I'm not as good a value investor as some out there because I can't pick my perfect entry. That's fine. I'm willing to accept my deficiencies as an investor. But even with my deficiencies, I've been pretty successful at doing so. All right? So the overexposure a little bit to the single stock I would look to rectify and improve upon, that of which I'm working on as we speak. The second of which is to get much more of a global representation within my portfolio. I'm absolutely looking outside of the United States to get some exposure abroad. And this is going to be really, really hard for me because what comes like the back of my hand in the US market, where I've got a lot of stuff just committed to memory, spouting off ticker symbols off the cuff, I'm going to have to really do some work and look to index and grab some exposure. And I'll start with Europe, okay? That's the number one. But I'll look to index some of that and add that into the portfolio, right? So that'll supplement my specialty ETFs through my spiders. It's going to supplement my index funding, which I do have some exposure to international there. Increase my exposure to the small cap Russell 2000 sector, all right? Those are some of the criticisms, even after 20 years of evolving my investor style. These are still some of the criticisms that I can draw up on a whim on my own specific investor profile and how I deploy my style in the stock market. Guys, thanks so much for tuning in to this video, man. I'm so glad that you were able to stay with me through it. If you like the content coming through, hit the subscribe button, hit the notification bell, leave your comments at the bottom. Please declare to me some of the attributes that make up your investing profile. It will help so many young investors come in and read what some of those factors are that influence their investing style. I can't break it down any clearer than that. Trust me, if I knew a way to do it, I absolutely would. But we will continue to evolve toward that message as we keep pushing this out and evolving the message for people who get this in their hands sooner than later. Guys, thank you so much for tuning in, and good luck in your investment future.